Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Hang Lung Properties Limited annual report. Hang Lung Properties Limited offers a diverse range of businesses and services. At the core of its operations are property investment, development, and management activities in Hong Kong and mainland China. The company operates through three main segments: property leasing, property sales, and hotel. Under these segments, Hang Lung Properties engages in various activities such as developing, leasing, and selling properties. Its portfolio includes a wide range of investments, including shopping malls, office and residential premises, retail spaces, serviced apartments, hotels, car parking facilities, and industrial premises. In addition to its core property-related services, the company also provides management and financial services. This includes apartment operating and management, project management, car park management, and property agency activities. With a long history dating back to 1949, Hang Lung Properties Limited has established itself as a prominent player in the real estate industry, serving both local and international clients. Hang Lung Properties Limited has experienced a significant surge in its stock price over the past year, increasing by approximately 69.89% from its 52-week low of HK $5.58 to its 52-week high of H $9.48. This substantial growth can be attributed to several positive news events and improved market sentiment throughout the year. One key factor contributing to the stock price increase was Hang Lung Properties' strategic expansion in Shanghai, where it announced a 20-year leasing collaboration with Shanghai Joinbai Group to redevelop the former Westgate Mall along West Nanjing Road. This initiative is expected to add approximately 96,000 square meters to Hang Lung's holdings and strengthen its competitive position in Shanghai's luxury retail market. Analyst upgrades and positive outlooks also played a significant role in driving up the stock price. CICC upgraded Hang Lung Properties' target price to HKD 10.4, maintaining an outperform industry rating, while research from HSBC and Citi showed increased confidence in the Hong Kong market and favored real estate sectors, including Hang Lung Properties. In addition, the company observed a strong recovery trend in tenant sales in mainland China, with declines narrowing significantly from -18% in late 2023 to -1% in the second quarter of fiscal year 2025. Retail revenue in mainland China remained flat, with higher base rent offsetting lower sales rent. Furthermore, Hang Lung Properties reported a 36% increase in new letting activity and a 57% rise in first-in-town brands compared to the previous year, indicating a successful strategic focus on differentiation and attracting quality tenants. The company's management also noted a stabilization and sequential improvement in several key areas throughout the challenging year, supported by external factors such as stock market stabilization, reduced outbound travel, and the introduction of tax refunds for overseas shoppers. Overall, Hang Lung Properties' stock price increase can be attributed to a combination of positive news events, improved market sentiment, and the company's strategic efforts to strengthen its competitive position in Shanghai's luxury retail market. Hang Lung Properties' limited market capitalization of $48 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Hang Lung Properties Limited holds a significant advantage in their industry. Hang Lung Properties Limited trades at a higher price-to-earnings ratio of 22 times and a lower price-to-book ratio of 0.35 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 36% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. the company have a dividend yield of 5.51%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline in the given summary can be summarized into several key points. Revenue growth is primarily driven by high occupancy rates, strategic tenant mix optimization, and targeted promotional campaigns. This is evident from the 57.4% increase in hotel revenue, 1% growth in rental revenue from mall portfolios, and 4% year-on-year increase in tenant sales in RMB terms. Additionally, malls such as Plaza 66, Olympia 66, and Spring City 66 have reported significant revenue growth due to their robust occupancy rates, sustained demand for high-end luxury offerings, and targeted marketing initiatives. On the other hand, revenue decline is primarily driven by weak consumer sentiment, persistently weak office leasing market in the Chinese mainland, and slower than expected economic recovery in Hong Kong. This has resulted in a 2.5% decrease in property leasing revenue, an 83.3% decrease in sales revenue, and significant declines in revenue for certain properties such as Heartland 66, Forum 66, Center 66, Plaza 66, Spring City 66, and Forum 66. The financial performance of the company underwent significant changes between 2024 and 2025. On one hand, the overall net income decreased by 12.3% in Hong Kong dollars and 11.1% in renminbi, indicating a decline in revenue or increased expenses. However, this trend was not consistent across all locations, as Park 66 experienced a notable increase of 54% in net income. The profit margins also showed mixed results. The operating profit margin decreased by 8.9% in Hong Kong dollars and 4.2% in renminbi, suggesting that the company's operational efficiency may have been compromised. In contrast, the net profit margin remained relatively stable, with a slight decrease of 0.4% in Hong Kong dollars, but an increase of 0.2% in renminbi. These discrepancies highlight the need for further analysis to understand the underlying factors driving these changes and identify areas for improvement. The company's debt level has shown some fluctuations over the past year. Initially, total debt decreased from HK $57,376 million to HK $53,589 million on page 20 and 21. However, this decrease is not consistently reflected throughout the report. On page 37, it is noted that interest expense on bank loans and other borrowings actually decreased from HK $0.003 billion to HK $0.804 billion. Regarding interest expenses, there are mixed signals. While gross finance costs decreased by 8% to HK $938 million on page 22, net interest expense increased from a loss of HK $184 million to a loss of HK $920 million on pages 29 and 35. This increase in net interest expense contradicts the overall decrease in total borrowing costs mentioned on page 37. Overall, it appears that there is no clear indication of significant change in debt level or interest expenses across all pages. The fluctuations are inconsistent and do not provide a clear picture of the company's financial situation. Management is committed to long-term development objectives through the Hang Lung V3 strategy. This initiative focuses on expansion in core cities, enhancing customer experience, and implementing capital-efficient reinvestments. The company's outlook is driven by its existing assets and government policies, with a goal of amplifying success while minimizing capital requirements. The company's financial history reveals a commitment to rewarding its shareholders through dividend payments. According to the provided summary, one of the key aspects of the company's financial strategy is the payment of dividends. This indicates that the company has prioritized returning value to its investors by distributing a portion of its profits in the form of dividends. A closer look at the company's financial records, as detailed on page 6, provides further insight into the specifics of their dividend payments. However, it is clear that this practice has been an integral part of the company's approach to shareholder value creation. That concludes the financial summary for Hang Lung Properties Limited. Feel free to comment below, and I will be happy to answer them when possible.